The South African Reserve Bank is set to announce its decision on the country's interest rates today. It's widely expected that the central bank will increase rates by 50 basis points, or 0.5%, as the rising cost of food and fuel impact inflation. Joining me to talk a little bit more about this now is Dr. Adrian Saville of Genera Capital. Dr. Saville, thank you so much for your time this morning. Let's start with some of the macroeconomic or market forces that are influencing this latest MPC decision, or could influence it today?
No, the backdrop is that inflation has been hiking in South Africa. If you rewind to the early parts of the COVID crisis or the COVID pandemic, inflation was running at very low rates, just under 3%, which is the bottom of the South African Reserve Bank's target. And from then, inflation, very much in sympathy with the global trend, inflation has hiked and now sits at the top of that 3 to 6% target. Over the same time, the South African Reserve Bank had collapsed interest rates to look after the economy, to look after consumers, to look after businesses. And through the course of the last 2 years, inflation has hiked and interest rates have collapsed. And so you sit in a situation where, in the language of economics, the Reserve Bank is now what we call behind the curve. And that the call from the inflation rate that we see is for the Reserve Bank to hike rates. At the same time, international banks around the world, and most importantly the Federal Reserve, has been in the business, in the US, has been in the business of talking about higher interest rates. So there's a range of pressures, domestic and global, for the South African Reserve Bank to catch up with inflation.
No, absolutely, and because South Africa is such an open market, we trade majority with the international with our international partners, Europe, the US, etc. This becomes even more of a factor in how the Reserve Bank manages prices and price inflation in the country, right?
Absolutely, you're right. You know, the fact that the South African rand is widely traded, heavily traded, means that there are a lot of eyes on the rand in not just domestic markets, and what that might mean for local inflation, consumers, households, business, but global eyes are on the market. International investors, global capital markets are watching the rand with a far sharper eye than is the case with many other emerging markets. The rand is particularly heavily traded, and in many instances, because of the sophistication and the development of our capital markets, this is where we are cursed for being good, but because of the sophistication of our capital markets, the rand is used as a proxy for other emerging markets. And for that reason, there is a particular disproportionate amount of attention paid to what the South African Reserve Bank is doing.
Yeah, I mean, I find it quite interesting your comment earlier about that the Reserve Bank is almost behind the curve, so trying to catch up on these inflationary pressures that we've experienced in the last 2 years. Interesting that inflation that we're seeing now is actually as a result of COVID and monetary policy decisions that happened during the pandemic. We haven't even begun to factor in the war, but we're seeing that in food prices. So how do these two things sort of come together, and what does that mean going forward for our inflation and for how we manage monetary policy?
That's a great observation, great question. Because there is a lot in what we are seeing in terms of inflation domestically that is out the hands or out the control of monetary policy. That if you hike interest rates, that's not going to reverse out the impacts of COVID. It's not going to reverse out food inflation. It's not going to cause supply chain blockages to go away. And in that breath, then you might be critical, or you might question why interest rates are being raised to address effects that have nothing to do with local factors and forces. So there is a disconnect there where South Africa, as you, I think, rightly observe, imports a lot of inflation. And that's what we're seeing now is a consequence of higher food prices, supply chain blockages, a slightly weaker rand over the course of the last year or so. And monetary policy, one could argue, in the form of higher interest rates, isn't going to change that inflation effect. And you could well question then the merits of raising interest rates if those things are imposed on us rather than caused by domestic circumstances.
And many South Africans will be questioning that very decision, because when they look at their pockets and what they're bringing in every month, their money is just not stretching. And so now asking them to pay more for some longer-term benefit of bringing down the prices, they don't really know how to reconcile those economic principles with their daily lived experience, hey?
You're absolutely right. And, to borrow again from international references or circumstances, this points to what, particularly in the UK, is being referred to as the cost of living crisis. That you are raising interest rates, causing a higher cost of living at a time when households are already strained. Now, if the UK is concerned or stressed about this, the circumstance of South Africa is that much more elevated, where we sit with 35% unemployment. Our per capita income is the same today as 10 years ago. The economy is just struggling to find its feet. When we get any type of economic growth, it doesn't really translate into jobs. So if there were a cost of living crisis anywhere in the world, or anywhere between the two of us, it is without question a South African crisis versus a crisis elsewhere, if we're looking for sort of comparisons. And in that circumstance of high unemployment, low economic growth, rising inflation, wages that have not increased to keep up with inflation rates, now the South African Reserve Bank is going to hike rates, and that will cause the cost of your home loan, the cost of your debt on your car to go up, and will also raise pressure on your business, which means there is a outside pressure on your earnings and your employment.
Lastly, Dr. Saville, just last month or so, it was expected that it would be a 25 basis point hike. But now all estimates are that it's 50, in line with this runaway inflation. Can we explain that?
Well, again, there's two factors going on here. There's domestic circumstances, which is what's going on with local inflation, how high are prices rising, or at what pace prices are rising compared to our interest rates. And if you take that just at face value, I think it could be fairly easily argued that the rand needs to hike not just by 0.5%, by even more. And the second is global circumstances. What are other banks doing? What are other central banks doing with their interest rates? And the one to point to is the Fed, the U.S. Central Reserve, and they are talking to not just one rate hike, but a number of rate hikes over the immediate future. And if you put those two together, there is it's very hard to escape the conclusion that the Reserve Bank should not be hiking when they announced their rate hike this afternoon by at least 0.5%.
Yeah, Dr.
And that we will see more after that.
Yeah, thank you so much for your time, Dr. Adrian Saville there from Genera Capital and lecturer at GIBS. Short-term pain for long-term gain, Ayanda. That's the message.